Then we also said another element of working capital, debtors or accounts receivable, because you also must bear in mind that your debtors must be managed properly. You must have a balance, because organizations sell on credit, okay? Because if you don't, then that means you may not be able to realize the needed sales or required sales. So meaning that much as you sell on credit, you must ensure that you manage your debtors well. In other words, you shouldn't be too lenient. Your credit policy shouldn't be too lenient, because otherwise, if you are too lenient, then that means your debtors may take advantage of your leniency, and they may not honor their obligations, and eventually your organization or the business will be losing. But also, much as I'm saying that you don't need to be lenient, you also you don't need to be too stringent, because if you also have a stringent or a strict credit policy, meaning that no cash, no service, that is also not good for the organization, because the moment your customers get to know that you are too strict, you do not advance credit, then they may end up switching to other suppliers, and eventually you lose so many customers. So you need to balance so that you maintain an optimum. In other words, the credit policy that is not too stringent, not also lenient. So that is another debt management of debtors as another key issue. Then also management of trade payables. Okay, because yes, you acquire items on credit, but then how do you manage your suppliers? Because if they are also not well managed, that means that you may damage your reputation with the suppliers, or you may find that your suppliers are quoting high prices, because if they get to know that maybe you are slow at paying, then they will end up really not delivering, or they will end up quoting high prices in a bid to cater for the time that you are going to spend with their money, especially if they know that you take long to pay. Or you may not get suppliers who are reliable, because no supplier would want to associate with a company or an individual who doesn't pay his or her obligations on time. Okay, so last week we looked at inventory. Now let's look at cash. Okay, and of course, when we talk of cash, that is the money that is readily available, and it may be either cash at hand or cash available at the bank. Okay, so any business requires cash resources, okay, for it to meet its obligations. Okay, because I told you earlier that however much a business is profitable, if you find that you do not have enough cash resources to meet your obligations, you cannot survive. You can't, even if you have assets. You have got so many assets. You cannot really operate. And this is what normally happens. Even we as individuals, you find that you have got so many assets. You have got chunks and chunks of land. You have got so many, in other words, you have buildings, you have almost each and everything in terms of the non-current assets. But if you find that those assets are non-productive, then you will end up struggling. You have the land, but the land is idle. It is not generating any income. That means you'll struggle. You'll find that those assets are not generating any income, and basically you do not have enough cash. You don't have enough cash with you to meet your obligations. You cannot pay your utilities, you can't pay, you cannot travel because you are limited, you do not have the liquid cash. But yes, the people, when they look at you, they say you have the assets. Actually, that's why you find that some people struggle in retirement. You retire, yes, you have invested heavily in some of these assets. Maybe you've been buying land, but the land is idle. You're not generating any income out of that land that you acquired, maybe during your active years of service. So once you retire, then you find that when they cut off that monthly income that you've been getting, then you find that you're struggling because now you do not have enough cash to meet your obligations. You are foreign sick, you want to cut maybe some portion of land now to sell. And by the way, when it comes to liquidating those assets, it is not something that you just wake up one day and then you say, let me sell the asset and you get the customer immediately. It takes quite some time. We find that the customers who come are not giving you the exact amount of money that you require. So you may actually decide to liquidate some of the assets, like maybe you have land and you want to sell it, and you find that it has taken a year for you to get the buyer. Okay, so meaning that as we manage our working capital, we must ensure that we maintain sufficient cash balances, okay, so that we don't fail to honor our obligations, especially when they fall due. Okay, when you retire, ensure that if you get that retirement package, do not go now to start investing in some of these non-current assets, especially which are non-productive. Find that you've reached 60 years. Now you have retired. Okay, they have given you your pension, your package, your gratuity, or they have given you an NSSF, and then you are thinking of constructing a residential house. That is not good, really, planning, because the residential house will not be generating any money for you. You will be sleeping. But where will you get the money to meet your obligation? And remember, as you grow old, also, that's when diseases come. You need cash to pay for your hospital bills. Okay, so this is something that we need to carefully look at, especially if we are managing our working capital and needs. But also, we need to bear in mind that if you find that you have too much cash also lying there idle, it is also not proper, because that means you are losing some maybe interest, or you are losing some return. That money would have been invested somewhere else, okay, to generate a return for you. So we need to balance. So why do we need cash resources? There are basically three major reasons for holding cash. One is for the because you need cash, okay, to carry on or to pay for the day-to-day transactions. Maybe you need to pay for your workers, you need to pay for the suppliers, utilities, or you want to acquire raw materials. You need to acquire raw materials. So that is one. Then another key reason for holding cash is precautionary, to cater for any unforeseen situations. For example, is breakdown in machinery, interruption in the sources of supply. So if any of those occurs, then at least you have got money to cater for them. Take an example, if you find that you bought inventory, all the money has been tied up in stock. Maybe you have acquired raw materials, all the money has been spent in acquiring raw materials. But then you find that in the process, maybe as you process the raw materials, maybe a machine breaks down and you do not have enough money, do not have enough cash reserves to cater for that. So what will you do? Okay, so it will affect your operations because all the money has been tied up in stock. Then also another reason is speculative. Okay, because in some cases you find that cash is needed to take advantage of any profitable opportunities as and when they arise. For example, if you find that maybe the prices of inputs have fallen, or maybe the share prices have fallen, okay? But of course, that shouldn't be one of the major, you should not engage in speculation, okay? But majorly, those are the three motives as to why you need to maintain some sufficient cash balances, okay, to cater for the day-to-day transactions, for precautionary, because I believe each one of us, if you get your salary at the end of the month, you don't spend the whole of it, okay? At least you must know when are you likely to get the next info so that you see how you can budget and ensure that you maintain some, to ensure that you meet some of the day transactions as you get the next info. Actually, you see, most organizations that get cash flow challenges is that they don't plan. And I've seen, especially in some organizations, when there is money, because at least I've seen in some organizations, when there is money, people will spend. They are not thinking about maybe the next day or the next month. And you see, there are some organizations where you find that the cash inflows come in at a certain period of time, maybe during the year. And then towards the end, you find that there is no, some other months are very dry, there is nothing coming in. Take an example like some of these private schools, private institutions, like private universities. You find that maybe students pay towards the end, especially when it is coming to exams. Okay, that's when you find that really you have your accounts are really looking healthy. But after some time, maybe when the semester is beginning, you find that maybe some little cash is coming in. In other words, you do not have enough liquid cash. Okay. So what normally happens is that when money comes in, you find you are spending. Okay. Because anyway, you see on the accounts, money is there. So you spend, not knowing that they are basically months when there will be no cash at all. And then you find that in such kind of time or period, you are even unable to clear your obligations. You can't pay salaries. Umeme is on your knocking on your door, threatening to cut you off. Oh, National Water is knocking on your door. URA is also knocking on your door. NSSF is knocking on your door. So all of them are on your case. So I already say that that is poor cash flow management, because if you are really in charge, you are heading at the finance function, then you should be able to forecast and see when do you normally get your the money, and be able to plan for that period also when the accounts will be dry. But when you get the money and then you find that you've spent all the money at once, then you'll be stuck. You'll be stuck. Like sometimes I've always been moving. You find you want to transact, you go to some of these agents of these commercial banks or mobile money. You reach there early morning and you want to transact, and the person tells you, maybe, can you give me $1 million? The person cannot give it to you, either because he has served one customer and he has run out of cash. Because if you are operating on working capital of 1 million, and I come to you, you have been operating at 1M, I come to you, I need $1 million, you give it to me. What does it imply? That all your money is going to be tied up in you will have fraud, but you will not have cash to serve other customers. So meaning that you won't be able to meet the demands of other customers, even if somebody comes requesting for 10,000. So you must see, what do you have? What do you have? Just a moment. So I was trying to say, you need to, hello, are you able to get me? Hello? Hello?
Yes, we do.
Yes.
Yes, we do.
No, when you're using, so when somebody calls, the network gets some challenges. So, so that is what I was trying to say. You need to ensure that at least you see what you need, forecast what you require, so that you maintain sufficient cash balance. Okay. So we are saying an organization should maintain sufficient level of cash to meet its obligations, because if it is inadequate, it means that you will fail to meet your obligations. If it is also excessive, okay, it is not good, it is not ideal, because you'll forego the return. So meaning that there is need for a trade-off between the liquidity and profitability position of the organization, so that you have enough optimal cash balances, balances which are not too high to jeopardize returns. No balances which are too low to threaten the liquidity position of the firm. Okay. So a manager who is risk averse, there are people who fear risks. Those who fear risks, you find that they will maintain high cash balances. And of course, yes, that will boost the liquidity of the firm, but you will forego return. Because you have too much cash lying with you, idle, is there lying idle in the bank? Or if you've invested it, the bank will just give you a little, low return. But one who is a risk taker will maintain a high cash balance. Rather, will maintain a low cash balance. And will end up investing any extra into profitable ventures. Okay. But of course, that may threaten the business with insufficient cash balance, and it may fail to meet its short-term obligations as and when they fall due. So that's why you're saying that you need to balance liquidity vis-a-vis profitability. When you see that diagram, the two must, liquidity versus profitability must balance. Your ability to pay the bills, okay, and also minimizing the hoarding of too much cash, in that you invest any excess to generate more return. And of course, it is not an easy task. Even we as individuals, I don't know how many of us balance the two, where you find that your liquidity position as an individual is matching with the other profitable ventures that you take. You find that most of us, when we get our income, we spend the whole of it, and in the end, we are struggling to meet our obligations. Why? Because we have spent all what we got into acquiring some of these long-term assets. Now, cash management policies and techniques. So to be able to determine the optimal cash balances, where both liquidity and profitability are achieved simultaneously, any manager should have a cash management policy which spells out, one, how are you going to manage your cash inflows? Efficient collection. Then also managing the outflows. How are you managing disbursement? Because the way you collect, efficiency in collection is very key. And also how you manage your disbursement. And then how do you manage any surplus cash balance? Because you may have a surplus, which is short term, which is temporary. So how do you manage that? Should you increase salaries because you've seen a surplus? Because you've got some surplus cash, then you've decided to increase employee salaries, because you know that is if you committed yourself to increase salaries, then it might be difficult for you to reduce. So meaning that would be a wrong decision. Okay, so if there is any surplus cash, so how do you deal with it? So when the cash inflows and outflows are properly synchronized, you will not have any problem in managing cash. Because that would imply zero balance between inflows and outflows. No surplus or deficit, meaning that what you need is what is available, and what you get is what you spend. The concept of zero cash balance, which ideally in practice is very difficult to attain, but we need to try as much as possible to ensure that at least we get there, much as it is hard. Okay. So an ideal situation, and in the reality, cash inflows and outflows rarely match. This is what I said. Okay. But there are two broad strategies which can be followed to achieve a zero cash balance situation. And of course, these strategies are one, how do you manage your cash receipts and cash disbursement? Then also, how do you manage the surplus and deficit cash balance? Now, let's look at management of cash receipts and cash disbursement. In most cases, a business will either have a surplus, especially where you find that the cash receipts exceed disbursements, and a deficit when you find that the disbursements exceed receipts. So to synchronize the two, so as to have a zero net balance, a financial manager should design measures aimed at accelerating your cash receipts. How do you ensure that your customers pay quickly? Then also measures designed to delay payments or disbursements, especially to your suppliers. But of course, bearing in mind that you do not, you should not be done. Now you need to be extra careful, especially with that. Okay. Otherwise, it may also affect your operations. And of course, there are a number of ways of how you can accelerate cash receipts into the organization. Number one, you can offer incentives to ensure that clients or customers pay early. Maybe give discounts. You can offer cash discounts. Those who pay early receive a discount. Those who take long, they don't enjoy that discount. Okay. Then you can also, like in some institutions, you find that if students pay a little bit earlier, maybe they don't pay registration fees. Registration is waived off. Like I normally see SCCA, I think they have got three. Those who pay early, they pay a little bit less. Then those who pay in the normal period, they pay a little bit higher. Then there are also those who pay late. You find that if you want to register a little bit late registration, you find that you're paying much more money than one who has paid early. Of course, that is an incentive. Because if you find that if I pay early and if I pay late, it is the same thing. Maybe a semester is 4 months. One who has paid early and one who has paid late is the same thing. So you find that people will hold on to pay. Maybe somebody will say, let me first invest the money somewhere else so that I can get some interest instead of paying. Okay. So once you offer incentives like early payment discounts, then automatically you'll be able to accelerate your cash receipts. Then ensuring efficiency of the internal process of preparing and dispatching customer invoices. This is very key. Actually, the ideal is that the moment you deliver the goods to the customer, make sure that the invoice is also delivered. Do not send goods. You have delivered the goods, but then the invoice goes after 30 days. So what does it imply? That you have delayed to deliver your invoice, meaning that if you've delayed for 30 days and you deliver after 30 days, when the client receives it after the 30 days, you also take some other 30 days. So all those are 60 days you are tying up your money in debtors. So the idea is that the moment you deliver the goods, let the goods go with an invoice. And your client should acknowledge that the invoice has been received. Okay? Because if you take long to deliver, if you find that your internal processes are not proper, especially the way you handle, dispatch invoices, then automatically you will have challenges with your cash receipts. Offering discounts, I've already talked about that, so I don't need to repeat it here. Okay. Then where you find that maybe transactions, actually the best is also to ensure that maybe your customers use electronic means. Instead of giving you checks, maybe they can use other electronic means which are very fast. EFT, RTGS, because if somebody gives you a check, that means it takes some time also to mature. And any day that passes by without you receiving the money, of course, it is a cost to you. Okay? Because we looked at time value of money. The money you receive now is not the same as the money you receive the next day. Then also, where you find that an organization has got decentralized collections, for example, where you have farms that operate in wider geographical areas, like Umeme, like Umeme and National Water. I think they no longer have these cash offices at their premises. So meaning that if you are to pay, I pay direct on their bank account. And like the previous years where you find that you had to go, maybe you take a check or you've taken cash to the cashier. So I don't think they allow now cash transactions. Okay, so you can have your accounts known to your customers so that money is deposited directly on your account. Then you have the logbook system. Of course, with this, the firm may establish a number of collection centers. Of course, this may not be applicable here really in Uganda. In Uganda, we may not apply this. So it might be common in USA and other European countries. Now, that is one way of accelerating cash receipts. Now, delaying payments. You can also delay payments, or you delay cash disbursement. So when you adopt this strategy, you need to ensure that it operates without hurting the corporate image of the firm or defaulting on obligations of the business. Okay. And of course, yes, when you delay payments, it gives some sort of temporary relief to the organization. But also, as you delay payments, you need to be extra careful. Because if, for example, you delay to pay some essential services, like you have delayed to pay for your utilities, or you have delayed to pay your employees, then that means that the morale will be down. Maybe you can delay the suppliers, especially if you have got cash flow challenges. But of course, as you delay them, try to explain to them. Do not keep quiet, because keeping quiet does not solve the issues. If there is any delay, try to communicate to your suppliers, or if you're going to delay payments, salaries for your employees, make the communication in time so that the employees are aware. You prepare their minds. But the month should not end, and then you just bump with the employees and say, we are not paying you because we are having some cash flow challenges. Because any financial manager, anybody who is managing the finance function, at least you would have known whether you'll be able to meet those obligations at the end or not. Because by 15th, you would have known whether you'll be able to meet your end of month obligations. So communicate a little bit earlier, okay? Of course, delaying payments can be in several forms. Number one, you can explore credit stretching possibilities. You can make payment through the bank because you take advantage of the processing time, maybe 3 to 4 days. But these days, some banks have put in place some innovations. Because I think now a check does not take 4 days. How long does a check take to mature now? Those who are working in the bank. Yes? How long does it take for a check to mature?
I don't work in the bank, but they usually tell us three working days.
3 working days. But if it is the same bank, that is instant.
Yes, it is instant when it is the same bank.
Yeah, you can delay payments. Maybe if you expect to get money in 3 days' time, instead of using EFT, how long does EFT take? An EFT. Two days also? Yes?
I think here we have one person. We have someone who works in the bank. I'm not sure he's here.
You have also not made payments via EFT?
EFT takes 24 hours. Huh?
24 hours.
Yes.
Then an RTGS?
It is also supposed to take 24 hours.
24. Oh. Okay, then you can also centralize payments, especially these are delaying techniques. But of course, I'm not saying that you should use them. Make sure that you look for money. You can centralize payments. And as you centralize, of course, you're buying time. For example, if the transaction was made in Mbarara, you say, okay, you see, but payment is done at the head office. That is buying time. Of course, there are several ways of how you can delay payments. And of course, not revealing it to your customer, to your clients that you have. But of course, you can tactically delay some payments, okay? As you sort yourself, as you try to source for what? For funds to clear your obligations. Then managing surplus and deficit cash balance. So if you have got a surplus, what do you do? What about if you have a deficit? What do you do? Okay. Because if it is surplus and you don't invest it, that means you have idle resources. Okay. But then also if you have a deficit, that means you did not do enough or you did not plan well. Okay. So when you are investing any surplus, you must be mindful of the safety of the investments. Okay. So that the need for profitability does not increase the risk of liquidity. Where you invest, there should be a low default risk. Okay. So that you are able to realize the interest as well as the principal. For example, you can invest in fixed deposit accounts, much as the return is very low. Or you can invest in treasury bills because those are low risk investments. At least you are sure that your investment is safe. Then also look at the marketability. Where you have invested, can you be able to sell those assets quickly? Can you convert them into cash with minimum possible loss? Because if you find that where you have invested, it takes you quite some time to convert the assets into cash, then it is going to be a little bit dangerous, especially where you get this. Okay. Then also consider the profitability. Are you able to get reasonable rate of return? Then also the instrument should have short-term maturity periods in order to minimize the risk of economic fluctuations. Then if you have got the deficit cash balance, you need to make arrangements to finance your deficits in advance to avoid panic measures. Because those panic measures may result into high costs of financing. So you need to plan well for the cash. Okay. And you need to ensure that the deficit does not go on for a long period of time, because if it goes on, then it is going to affect your operations and even your image. Actually, if you are in an individual and then you have some maybe debt, because I've seen some people, you find somebody borrows here, he pays here. When the period expires, gets money from here, clears the other one. So that is, you buy time as you really plan. So you get the debt, pay debt. I don't know whether that one works. Does it work? If I may ask you, how do you manage your cash flows? You get the debt, pay debt. Yes, It is some temporary relief. You are relieved for some time, and you find that you maintain the relationship with your clients, because they know, because if I get money, I pay you. The next day I may again come back to you, I get from where I pay the other one. But of course, that one is not sustainable, because you reach a time and you find that you are stuck. So you need to anticipate the firm's future cash needs over a definite period of time. Then you also anticipate the firm's cash resources over the same period of time. Determine the periodic cash balances, and of course, how you manage those balances. Okay, and of course, you can do this by preparing a cash budget. Because once you prepare a cash budget, you are able to predict how much you will require within a given period of what? Time. You're able to forecast your receipts and of course your outflows. Okay. And of course, this brings us to a cash budget and a cash forecast. Of course, a cash forecast is an estimate of cash receipts and payments for a future period and existing what? Conditions. Then a cash budget, a commitment, a plan for cash receipts and payments. Okay. For a future period after taking any necessary action to bring the forecast into line with the overall business plan. Okay. Now, of course, we have got the format of a cash budget where you have your cash receipts. Okay. And then the payments. Now, there is an illustration here which demonstrates preparing a cash budget. Of course, the first section is the receipts, and then the second section is the payments. Once I get...
Excuse me, sir.
Yes, please.
I beg your pardon on what a cash budget is.
I said a cash budget is a commitment, your commitment to a plan for the cash receipts and what? Payments for a future period. Having considered all the necessary actions that bring the forecast into line with the overall business plan. So in other words, you're looking at what you are likely to get in any given period of time, and of course, the disbursements. How are you going to spend the resources that you would have gotten? Okay. What are you getting? Now, like, what if I'm preparing my cash budget for this for the next 6 months? We are in August. So I will forecast all my receipts. What am I likely to get? Okay. And of course, how will it be spent? Now, this is my cash budget, the format. You'll have different periods, period 1 to maybe period 4. So you have receipts, and of course the receipts could be in several forms. Maybe it could be receipts from your normal operations. You could also have other receipts from activities which you don't do daily. Okay, maybe you have disposed of some non-current assets. We have received some donations or grants from the government or from any funder. So all those will be, and of course the cash, what is most important with the cash budget is the timing. Because timing is very important. When do you get the actual money? Okay, when are you going to get the actual receipt? So we need to bear in mind the time period when the receipts are got, and then also in terms of payments, when are the payments to be done? When do you pay your suppliers? When do you pay for other services, maybe utilities? Okay, so meaning that if, for example, period one, I need to get my total receipts for period one, I less any payments made in period one, and of course, the balance will be the closing, which will be the opening for the next period. Okay, because if I have receipts here, I get the total, I have the payments here, I get the total receipts minus payments, I will get my net. If I add the opening balance, we mean that yes, there's some cash reserve that you had maybe at the beginning of the period. So you add it, and then you have your closing balance. And this closing balance at the end of the first period will be the opening in the next period. Because if I close with a cash balance of say 5 million at the end of August, if I'm looking at September, the closing for August will be the opening for September, and to go on like that till I finish the period that I'm looking at. Okay. Now there is an illustration here of Banda Investments Limited, a company which is engaged in the production of leather products. Then the company makes cash forecasts every 4 months, one being from June, such as September. So we have the projected sales, June, July, August, September. The sales are here. Okay. The company expects end the month of May with 17.2 as cash at bank and at hand. Here they have combined the two. 70% of the company sales are made on credit. 90% of the balance is collected a month after sale, and the rest is estimated to be bad debts. The company plans to sell a piece of land in July for 15 million. The total cost of raw materials to be purchased are worth 31,270,000 in June, and in July they've given us the figure 39.53. And then August, they have given us the figure. September, raw material purchases are paid for 60% in the month of purchase and 40% in the month after purchase. All other cash expenses are estimated to be 20% of the sales revenue and are paid for in the month they are incurred. Capital expenditure, they're telling us that for the year includes purchase of machines at 20 million in July and 34 million in August. Arrangements have been made with the bank to borrow 15 million at the beginning of August, and the borrowings are paid in 4 equal installments at the end of each month, and interest of 2% per month on outstanding balance. So they're saying that we prepare a cash budget for the period ending September 30th, 2011. So this is our cash budget. Now, what we need is that we need to first have a series. Before we even come to this, we need to have a series of workings so that we're able to time when these cash inflows, the period when they are coming in, and also when payments are made. Now, if I come here to the receipts, okay? If you are looking at the sub budgets, in other words, for revenue and payments, because you need first to look at them and see the timing. Now, like for sales, these are our sales. And they are saying when you check on the first, okay, on the sales here, these are the figures that they have given us, but there is a note on sales, okay? When you look at the note, this note 2, that 70% of the company's sales are made on what? Credit. 90% of the balance is corrected a month after sale, and the rest is estimated to be bad debts. So what does it imply? If they say 70% of the company sales are made on credit, what does it imply? What is on cash?
30%.
Cash is 30%. Okay, so meaning that if you come here and you look at the cash sales, what you see here, which is received in this month, let me give it a different color. What you see in the respective month when the sale occurred, it is 30%. Do you see that? Now take an example. What was the sales for June? Sales for June, it was what?
62,500.
So when I get 30% of 62,500, what do you get? What do you get? 62,500.
18,750.
18,750. So this is the cash. Sales, 30%, you can say this is cash. Now we go to June. July. What is the sales for July? 68,800. And remember, 30% is cash. You receive it immediately. So 30% of 68,800, what do you get?
2640.
2640. I think you have all seen how these figures have been derived. It is 30% of the respective sales in each month. Is that one okay? Is that one fine? Anybody having issues with generating those figures in the second line of our cash? Before I move to the next, because now you have seen that in each of these months, these figures are derived by getting 30% of the respective sales in each month. Because that is what they're telling us, that you receive it instantly. It is not. Now, let's go on correction now. If you have received 30% on cash, so what has remained? What has remained uncorrected?
70%.
70%. So if it has remained uncorrected, that means that if you come here in your sales, here, the correction. That means, and what are they telling us? When do you correct that 70%? Do you correct by the whole of it? So what are they saying? 90%.
We are collecting 90% in the month after sale,
Yes.
and then the 10% of that 70 is bad debts, meaning that we shall not correct it. It should be disregarded.
That means we shall not because now if it is bad days, that means we shall charge it within the expenses. But now in the cash budget, shall it appear?
No, not really.
No, we shall not bring it here. But of course, when you are preparing your account, these bad debts, you will expense them off, charge them within your operating expenses. But in the cash budget, the items like depreciation, bad debts, these are non-cash. So we shall not bring them in the cash budget. But when you're preparing your profit statement of profit or loss and other comprehensive income, at least you bring in those bad.
Oh, yes, best one in the whole universe.
Mom, we are going to want cake because we have cake
Hey,
because you
you're
don't have
starting with
the
your
great
baby.
butter.
Is there a cake?
Yeah, and there's cake.
Kayesu Proskovia, please tell your kids to go away. Tell them you're in class. Let them get the cake after. Now, so 90%. So 90%. So that means the correction here is 90%. Actually, let me put it here in the cash budget so that you know. Correction here, we have corrected 90%. And when is it corrected? In a month after sale. This is what they're saying. 90% of the balance is corrected a month after sale. So what does it imply? Your sales for June were 62,500. But remember 30% was cash. So what is the credit sale in June?
It's 90% of the sale. The credit sale is 70% of 62,500, which
It is 43,750.
43,750. But they are saying out of that, you correct only what?
90%,
90. So meaning
which is
that
39,375.
39,375.
375.
And you get it when?
The next
1
month.
month after sale.
Yes, you get it in July. The same applies to this, because now this figure is 90% of the 70% of the sales of what? July. You know how the 43,344 was got? How was this one got? Our sales
It was good by first of all getting the 70% of your July sales, and then out of that also getting 90% of the July sales.
Of the July. So that means you correct it in August. The same applies to September. It is 70% of the sales of August, then times 90%, which you correct in September. So that one is okay. I think that one is also clear.
So then what happens for the one of September?
The one of September, you see our cash budget we are looking at, that one will be corrected in October. But our cutoff now is September. Our cutoff period is September. So meaning that as you prepare for the other 4 months, October to December. Because now this is 4 months. June, July, August, September. So the next one will be October, November, December, January. So that's when we consider the ones of September. So I think that is for the sales. So that one is okay. Then the company plans to sell a piece of land in July. So that one is also fine. That's why you find that in our cash budget here, we have an inflow of 15 million because it is coming in July. So that one is also okay. Then they are saying that, of course, these are payments, total cost of raw materials. These are payments, these are payments. So we need to exhaust the receipts first before we go to payments. Any other receipt? There is this receipt. Arrangements have been made with the bank to borrow 50 million at the beginning of what? August. I think you are seeing this in August. This is an inflow when you get the money. And it is coming in when? August. Leave alone the payments. So that one we shall handle it when we come to payments and even the interest. Any other receipt? Do you see any other receipt? I think those are the only receipts. Okay. But of course, when you check, there is this opening balance. The opening balance at the beginning of June, which is here. Because they're saying that the cash balance at the beginning of June was 17.2. So that is what you open with, and then you add the receipts for that particular month. That's why you see 7.2. I've added my receipts from sales. That is 30% cash that I received immediately. And those are the only receipts for June. Now, I come to payments now. Because say that there are two sections, receipts and then payments. And when you come to payments, you have purchases. Let's see how the purchases were derived. Now, the purchases are given here. Total cost of raw materials to be purchased are worth 31.27 in June. In July, the figure is here. August, this is the figure. No, this is for September. This is for June. Then you have July, you have August, and then you have September. But how did you pay for these raw materials acquired? Were you paying immediately? Now, check the next note. Raw material purchases are paid for 60% in the month of purchase and the 40% in the month after purchase. So what does it imply? The purchases for June, what shall we pay for cash in that particular month? 60%. What is 60% of that figure? What do you get?
18,762.
Now, you see, I have 18,662. And remember, these payments will be minus. You know, you may not show them here. You may not show, you can have them without reflecting the negative sign so that you
Can we
add
put
the total
brackets?
payments. Yes?
Instead of
1870.
putting a negative, can we put brackets?
Yeah, it is also, actually, you may not even put brackets. You may remove these negatives. You may remove these negatives and do what? So that you add, you will add your total payments. Anyway, let me leave them there. Since you know that, but at least you know that the payments will be a deduction. Because you can put another column here and you say total receipts and then total payments. Let me see, they can be able to add. No. So you can have the total receipts, then we shall have the total payments. Then later on we payments for any given period. Then for this July, how was the one of July got? %60 of this of the purchases of July. So I think you have seen all how we've gotten this figure. Because this is 60%, 60% of the current month purchases. Is that one okay? So can we proceed? That one is clear. Because you see cash budget in most cases, when it comes to management of cash resources, cash budget may not miss.
Well, Boaz is asking a question. He has sent it to me as a direct question. Okay, he says, I'm having issues with raising the hand. Assist me to ask the lecturer if the company plans to sell land at 15 million, does that qualify to be a receipt?
Yes, it is a receipt. It is a receipt because money is coming in. If you say that, don't you get the money?
I think so.
Maybe, Doctor, hello?
Hello?
Thank you, Linus, for raising my question, because I was having issues here with raising the hand. But what is confusing me here, the statement is the company plans to sell the land, but it has not sold. I'm having confusion with a statement. It's like an intention, but an action has not been done of selling.
Yeah, but you see, you're preparing your cash. When do you plan to sell?
Yes.
When do you plan to sell? In August. And does August,
yes,
fall within your period of cash budget? Because this is a budget. A budget you don't prepare for that particular period. You are budgeting for a certain period.
Okay.
That's why
Thank
we have
you.
that money in the month of August, because that is when we plan to do what? To save.
Yes. Okay. Thank you, Anthony. Thank you, Linus.
Then for purchases, we are through. Now let's see suppliers. When do you pay suppliers? Still the 40%. The 40% in the month after purchase. So meaning that this one which you see here, it is 40%. The one that you see below is 40%. Because 40% is paid 1 month after sale. We are saying 40% is paid 1 month after purchase, rather, not sale. So if, for example, you purchased 31.27 in June, what is 40% of that figure? What is 40% of that figure? Mm-hmm. 40% of that figure is what? Of 31.2.
It's 12,508,000.
And that is going to be received in which month? The next month, not in the current
In the month of July.
That's what you see here. So all these figures, you need to realize that they are got as a result of looking at 40% of the sales of the previous month. So mean that this 15,812 is as a result of 40% of the purchases of July. Then this 24,374 is 40% of the purchases of what? August. So that one is also okay. Then we go to expenses. All other expenses are estimated to be 20% of the sales revenue and are paid for in the month they are incurred. So these ones are paid instantly. In other words, once you incur the expense, it is cleared. There is no need to wait. And they're saying it is 20% of the sales revenue. Okay. So meaning that if you look at these expenses, which you see here, you need to look at the sales. What were the sales for January? Sales for January, it was 62,500. 20% of that is what? That gives you 12,500. Sales of June, rather July, it was 68. 68,800. Multiplied by 20%, that gives you 13,760. I think you have all seen where I have got these expenses. It is 20% of the sales revenue of each month. Let me put it here, 20% of the sales revenue of each month. Is that one okay? Okay, now there was purchase of machinery. And when was this one done? Let's go back to our question. Capital expenditure for the year include purchase of machines for 20 million in July and 34 million in August. So this 20 million and 34, the one that you see was machinery, purchase of machinery, and of course it was done in July and August. Now we got loan repayment. Arrangements have been made with the bank to borrow 50 million at the beginning of August. Borrowings are paid back in 4 equal installments at the end of each month, and interest of 2% per month on outstanding what? Balance. Okay. So when I get 50 million divided by 4, what do I get? 50 divided by 4.
12,500.
And when was the loan acquired? The loan was acquired in August.
August.
So that's why you see payment for the principal. This is the principal now. Loan repayment. We looked at loan amortization. This is the principal, the one that you see here. Okay. This is the principal, but we also need to know loan repayment. This is the principal. So that means every month, beginning at the end of August, you have to pay back. Okay, you have to pay back 3,500 every month. But then the interest, they are saying interest has also to be paid. And interest of 2% per month on outstanding balance. So if I come here, I look at my interest. That means the first month, 2% of 50 million is what? 0.2. That is 1 million. You see what you pay in the first month. So what will I pay in the second month? Second month I will pay what? How do I get the 750? Who can tell me how the 750 has been got?
It's 50 million minus minus what? Minus the loan payment for the percent of that. So 50 million minus 12,500 is 37,500. Then 2% of that is 750.
Yes, it's 750. Okay, so that is for the second month. I think you have also seen how the interest has been got, because it is 2% reducing balance. The same applies if I got October, but now my cutoff period is September. Now, having got the payments, if I get the total receipts minus payments, because now if I get, what is the total for this first month? What is the total? Get for me the total payments for the first month. Total payments. Total payments. What is the total here? Anybody who is adding 17,200, add 18,750, add 18,762. That gives me 54,712. Okay.
Isn't 18,762 an expense?
Which one? Hey,
That
Yes, it's an
18,762.
expense. It's an expense.
this one is an expense.
Mm.
It's an expense.
So you get 35,950.
You get 35.
950.
So this one, let me put it here. Now 39,950. Remove,
35,950.
then remove the expenditure now. 18,762 minus 2,500. What do you remain with?
4688.
4688. So this is the closing balance of cash. Closing cash balance. And since it is the closing, it is going to be the opening. As you open July, it is going to be the opening.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12.
Please try to organize your, as you draw, include the totals. So that's why this 4688 will be the opening here in July. Then you add the receipts for July and less expenditure for July. So meaning that once you add, this is going to be the closing cash balance at the end of July, which will be the opening at the beginning of August. Okay. Add the receipts for August, then less expenditure for August. Then you will have the closing at the end of August. This closing balance for August will be the opening at the beginning of September. Add receipts for September, then less the expenditure in the month of September, and then you'll have your closing cash balance at the end of September. So basically, these lines, you need to first leave them, especially the opening balances. For the subsequent month, you need to leave them blank as you are preparing your cash budget, so that the closing of the previous month will be the opening of the new month. And then you add receipts like that, okay? Now, if I may ask, when you look at this cash budget, what would you conclude? What would be your conclusion? Like you've prepared your cash budget. This is how it is now. Is it healthy? As we wind up, what do you conclude?
I think it's not healthy because your budget has exceeded the cash available. Since it's negative.
You see something, you don't need only to look at this last figure.
I think it's healthy for the first 3 months, and then in September, there is need to manage the cash better.
Sure. The first 3 months, you have got a positive cash balance. September, But there are key issues that I am seeing here, which ideally are not proper from what we've looked at. Because you see, even the cash, the cash balance that you see, which is positive, it is as a result of selling off, disposing of. Because
I
now,
think this,
look at July, you sold the land. August, you got a loan. Company is doing well in terms of.
I think this company is over trading. I think it's over trading. When you look at their purchases, they are spending more in buying, in stocking, or in buying the raw materials, and they want to liquidate their fixed assets to try and support the day-to-day running of the business. So I think the management is not really
They are
point.
tying much of the money in acquiring raw materials. That is number one. If you look at the
I also think they are heavily financed by debt.
Yes, financed by debt. Most of the operations are financed by debt. And you know what causes that? Is that these people take long to collect money from their debtors. Look at what you collect instantly. 30% cash. That's what you get instantly. And then the remainder, 90%, is collected a month after sale. So you give your debtors how many days? 60 days? Or 30? And when do you pay your suppliers?
30 days.
When do you
Only
pay?
that when I look at it, the payment, the collection and the payment periods are the same, only that the percentages are a bit unfair, because if you're only receiving 30% in cash and you're paying 60% in cash for raw materials, that means the management of debtors and creditors is not.
It is not proper, because you cannot collect 30% and you're paying 60%. So what does it imply? That the other 30%, you are getting it from other sources. And that's why you are selling land. And then you are also getting loans from the bank. Why? Because you need to finance your payables. And of course, that is a result, because if you find that you are collecting money, you're collecting less than what you pay out, then it is going to have a negative effect on your operations. And why this company is disposing of its non-current assets and even acquiring a loan in July, it means that the money from itself is not sufficient. The corrections are not sufficient. Finance its payables. That's why it is selling off land, and it is also acquiring loans in the month of August, because the corrections, that means the credit manager, what would you propose? Should be sacked or promoted? Because he's not doing his work. That is number one. Secondly, by the way, if you look at the percentage of bad debts written off every month, don't you think there is a problem with the credit policy of this organization? The credit policy and the way because you cannot write off 10% every month. That is not proper. And yet you find that, and a company that is really having such cash flow challenges, find that you are buying assets, because look at capital expenditure now. So capital expenditure in July and August, where are you getting the money? From borrowings. You're buying machinery. So ideally, instead of buying, look at other options. Because if you incur all this money at once in the month of July and August, it's going to have an effect on your operations. Either maybe you can consider leasing those machines that you require, or you may consider hiring in the short term as your cash flow stabilize, because you are facing cash shortages, and then you are thinking of buying or incurring capital expenditure. It actually also the timing of capital expenditure is also very important. When you have cash flow challenges, don't go for capital items. Consider maybe leasing, or you consider hiring, because if you have that one-off cash payment, it is going to have an effect on your operations. So those are some of course, there are so many issues that you can identify within this scenario, okay? Because at this stage, it is not only preparing the cash budget, but also coming up with a thorough analysis of what you have observed from what you have prepared, okay? So that marks the end of cash budget. Our next area is going to be management of trade receivables or debtors, which ideally we shall look at next week. And then I will send more practice questions on cash budget. What cash budget is very, very key, very key. Okay, so I will send some more practice questions on cash budgeting, which I expect you do, because when it comes to cash management, a cash budget is very, very, very much important. Okay. All right.
Someone asked a question. Someone asked me a question. Do you have a YouTube channel where we can find some of these lectures?
Yes, I have not uploaded for MBA, but I think I will upload. Then I will put some of the links there. So let's give
so you have a YouTube channel.
Yes, but I have not uploaded them for MBA. They are not uploaded. What is there major is for undergraduate. Other courses for undergraduate. But I'm going to upload also our recordings for the previous sessions so that you can access them.
I think that would be great.
Okay, I have a question.
Yes, please.
We need to show the workings of how we go to the 30. Do we need to show the workings of how we go to the percentages? Like when you see the 30%, the 7%, we need to show working.
Yeah, if it is an exam, you can really have some working somewhere. If it is an exam. Okay. Because even I know in practice, you need to have working papers, how you have generated those figures. Okay.
Yes, sir. I also have a small question. I wanted to know if the cash budget similar to a cash flow statement?
No, they are not similar. Statement, okay, you are looking at cash inflows and outflows. They are not similar. They are not. Because I think we have, don't you have a cash flow statement here? I think it is not here, but I will send the cash flow statement so that you also know how it is prepared. But they are not similar and they don't serve the same purpose. Okay, any other issue?
Maybe to remind you, you had said you're going to extend the deadline.
Okay, I will extend it by
Actually
I will extend it by 4
Then
days.
of course there are also some of our colleagues who have still failed to. There are those who have also still failed to enroll for just a few. So how do you think we can help them? I don't know if there's an alternative of them sending via the email.
You know, when work is sent in one place, it helps me especially when we are processing the results, because you know, email, you receive so many things, and eventually tracking that, by the time you have to grade and mark and grade, you find that you cannot even trace, you can't even where really the work was. So that's why
Does LMS
RMS
does LMS
at least,
does it allow?
Yes.
Does LMS allow if, for example, one of my colleagues was unable to do it, so I can use my account to upload for them?
No. You don't use your account. Person must use his account. Those who are having challenges, if you reach the ICT people, they may help you with those, with enrolling you. You can reach Amos. I don't know whether you know Amos.
I've been in touch with Owen. Amos is the lecturer, yes, Bakashaba.
Amos Variasha.
Variashaba, yes.
Yes. He can be able to assist you, especially where you are getting challenges with your LMS account. Because now, you know, email, yes, email can, but maybe unless it is an email open specifically for that. But if you send to my personal email, because I receive so many emails almost every day, and by the time you find that you reached grading that work, you can't even trace it. Some emails you delete because you want to get stressed. You can't. Yes. And when you are deleting, you don't go one by one. Sometimes you select the entire and delete.
I'll advise my colleagues to.
Let's try to use RMS, because at least there is a permanent, you know, it is a permanent record. Remain there, and if there is any issue to refer to it, you can always go back. Email after some time becomes hard, because even if I'm not there, but if you submitted your work via the RMS, then at least any other person can be able to come and log in and trace it. But if it is my personal email, and maybe, God forbid, I'm not there, then that means that would be challenging.
You're right. You're right. You can see.
All right. Okay.
Thank you so much for this lecture.
We meet next week. Bye-bye. I'm trying to get in touch with Professor, because we meet Professor in some sessions. So when he comes, we'll be able to begin from where I will have reached.
Okay, sir.